So you've probably heard about this. There is a new provision under the OB3 that creates a new type of savings account for children. Hello and welcome to another episode of Connecting the Dollars. Today we are going to discuss the new 530A savings account. This is a new type of savings plan that is created to benefit young people so they can save and have some income when they turn 18. So the contribution limits for this new account is $5,000. It behaves like a traditional IRA, but there is no earned income requirement. They're kids, so especially babies are allowed to sign up for these accounts. So if you are more curious about learning about these and how to set them up, stay tuned and also give us a like on YouTube, sign up to follow us, and you'll get all that information more easily to you. So Amanda, go ahead and explain how these new accounts might compare and contrast to the accounts that already are out there available for savings for your kids.
Sure. Thanks, Emily. So I think the main vehicle people use to save for their kids right now is a 529, just because the college costs are so big. So after saving for retirement, if you have extra disposable income, a lot of people put money in a 529 to save for their kids. So this new 530A account, people are asking, should I use that instead? And so one way we can analyze that is to figure out how it compares to a 529, right? So the 529 accounts vary. Those are run by states. Different states have different plans. They have a lot in common, but there's details that are different. The 530A account is at the federal level. So that's one difference, being that when you contribute money to a 530A, you may or may not get the tax deduction that you get at the state level. So many states offer a tax deduction for contributing for 529. So that's one difference. The pros are both of them can be used to grow your account in a tax-free way. So you put the money in and then it grows and then you're not paying tax on it while it grows. Ultimately, though, the 530A account will be converted into an IRA, which means you will have to pay income tax on it when you make a withdrawal. When you make a withdrawal from a 529 to help pay for college, that is not a taxable event if you're using the funds for a qualified education expense. Those are pretty big differences. The other one I just want to point out is FAFSA. So if you are going to be applying for financial aid, the money in a 529 is not going to count against your award. FAFSA currently considers a little more than 5% of the value of the account in your financial aid award. Current rules on IRAs is the balance does not count against you in an award, but if you make a withdrawal, that does count as the child's income. And so if you do make a withdrawal from an IRA, it can really count against you when you're paying for college in a way that it doesn't if you're in a 529.
Right.
Those are the highlights.
And Amanda mentioned taxation. There is no federal tax deduction for this type of account. So if you're waffling between a 529 and a 530A, one of the benefits to the 529 is that, as Amanda said, there are potential state tax deductions. Whereas in the new accounts, there's neither federal nor state, at this time at least. So the basic plan of how they work is you open the account, let's say when the child is born. They may or may not receive this pilot money of $1,000 that is currently available for new babies born 2025 to 2027. We'll see if that gets extended, but the only eligibility requirements is to have a social security number and to be under the age of 18. Whether that makes sense or not to have one, Amanda will get into a little bit after this. The types of investments are very limited. You have to be invested in an eligible investment, which is a qualified index. So an investment that tracks a qualified index, it does not use leverage. There's several different rules, and they actually may add to that in the future, so we'll have to keep an eye on that. So basically, you have this money in this account. You cannot touch it while the child is under 18, and when they do turn 18, it basically turns into a regular traditional IRA account, but follows those same rules. So it doesn't mean they get all this money at 18. It just means it transfers into their name. If they want to take it out, they will have to pay taxes on it, and they will also be subject to a 10% early withdrawal penalty if they're under the age of 59 and a half, which they would be, unless it meets a few exceptions that are already standardized under the IRA rules. So it can be a little tricky, but it's supposed to just be like a set it and forget it type of investment. So the general idea is there, but in practice, you have other options potentially. So getting into a little bit more of would we recommend them? Amanda, what do you think?
Like anything in personal finance, it's personal. So we can't give a general recommendation. Do we recommend them or not? If you would like a personalized recommendation, please reach out. You can find us on our website, a link to schedule an appointment for a consultation. But speaking generally, it really depends on how much disposable income you have, right? So if you're already saving for retirement and you're already putting money in a 529, do you have extra money to put into these new types of 530A accounts? For the vast majority of the population, that answer is probably going to be no, but there's still a lot of people who the answer would be yes. So if you are in that position, should you take advantage of the account? One thing to consider is that, like Emily mentioned, if you have a young baby, you can get the bonus $1,000 in the account. That's free money. You never want to say no to free money. There's also a lot of employers have pledged to make contributions for their employees who have had babies. So if you are working for one of those employers, it might be advantageous to open the account to take advantage of getting those funds. And then beyond that, the account details are still in development. As Emily mentioned, there are restrictions on the type of investments you can use. We don't know exactly what those investments are going to look like, so we can't evaluate at this point if the investment options will be good. They're still working on the details, so we can maybe record a follow-up video on that point in the future. But other than that, I would say don't say no to free money, and whether or not it makes sense for you as part of your retirement planning and your college savings planning really depends on your situation.
Yep. So that was a great wrap up. Thanks for that. As of the time of this recording, we don't really know exactly how that's all going to work because the accounts will not be opened or funded until July 4th of 2026. So we can send an update once that happens. But thank you for listening. Thank you for watching, and hope you enjoyed our content on this today. You can subscribe if you don't mind. If you like what you're hearing, sign up for a consultation with us at our website, propelfinancialadvisors.com, and we will talk to you next time.